Atul Shinghal, Mr. Raamdeo Agarwal. I'm the CEO and founder at Scripbox. So thank you for joining us. We have about nearly more than 200 people who've dialed in to listen to you. This is all about you telling us about your experiences in the market. What do you think of the emerging situation, sort of the buy right, sit tight philosophy. So it's over to you to talk about your journey. What are you feeling about the market? The questions we've heard from our customers are, is this a good time to invest? Should I withdraw everything? Should I stop my SIP? When do you think the recovery will happen? So the common concerns are exactly the same. I'll hand it over to you to tell us your thoughts on this. It'd be lovely if you can talk about your journey for a little bit, how you started and where you've seen the markets, and obviously talk about the future. Over to you, sir.
Yeah. So good evening, friends. Thank you very much, Scripbox, for hosting me. And it's a pleasure to be talking to all of you. And particularly in this uncertain time, turbulent time, nobody asks whether to invest in equity in good time. So it is only in bad time this question comes up, whether to invest in equity and equity at all, or how much to invest in equities. So these things come up when markets are down and the returns are very low for some time, maybe 2 years, 3 years, 5 years. So its nature of market is very turbulent. Let me tell you my experience of 35 years in this market. I started in 87 and we started with Super Zero. We were migrant students in the city of Mumbai, myself and Motilal. We had, supreme confidence in our own capability, which was very limited, but we thought that we are kings. And the market was always there as an exciting place every day. Doing interesting things. So first 4 years it was a struggle because it was a bear market. Post 1985 boom. So it was very challenging time for first 4 years when we started. That was good thing. That the moment we started, markets didn't take off. So we know that making money in the stock market is not that easy. Even as a broker or as an investor, it was not easy game at all. But it was a flat or bearish market. We were playing in a small cap, mid cap, unknown companies, and we were making some money here and there and some brokerage. But one thing I was doing was I was buying stocks against my brokerage itself. Whatever is my brokerage in 15 days, I would buy the stock. So in the Volan, I used to get only stocks. Never I got money. So that's how I was a voracious buyer throughout my life. And in last 35 years, I never seen money. I have seen only stocks. But we had discipline of buying, and we thought we are smart guys. We can read balance sheets. There are very few chartered accountants. Competition was very low. In broker's office, you could sit, read the balance sheet, and go and buy a stock and still make money. That was, reading balance sheet was a huge edge at that point of time. Nobody used to bother about the balance sheets. So, so that was first 4-5 years. Then we collected about 15-20 lakhs, and we bought membership in a stock exchange. And so we had zero capital and just the membership and big hardworking kind of partners. In next 18 months, so when you are there in some place, opportunity strikes you, and Harshad Mehta bull run happened. In 18 months, because I was continuously buying, as I told you, my style was to buy stocks every day. I was continuously buying stocks, and we made 30 crores in 18 months out of nothing. Brokerage plus the brokerage reinvested, and all sorts of things we did. But I never speculated. One thing was very clear. I'm not going to buy more than 100 rupees worth of stuff. If I have 100 rupees in pocket, I'm pretty happy buying 10 lakhs. My clients might be bigger guys. The world might be doing dealing in thousands of crores. But I was happy with buying my 10 lakhs, 15 lakhs worth of stuff. That's how we kept on doing. And so much so that in 91 at some point of time, I signed a check of 1 crore rupees. I had kept a Xerox copy of that in life I have signed 1 crore rupees check. So that was the pride I had in 91. And that was and then it had to collapse. It was very artificial, that entire scam money had entered. So it collapsed. So our 30 crore became 10 crores. So that was the first shock of seeing 2/3 correction in our portfolio. But we never knew when it became 30 and when it became 10. So we never felt the pain. And we was very happy that we have at least 10 crores. Now we can buy our car, we can buy our house, and still run the offices, and fantastic. We were damn pleased. And we knew now nobody can throw us out. We are invited in all the parties. And that's how it was. We were reading balance sheets. And then we heard about And 94, 95, we heard about Buffett. I started going to listen to him. That changed my life altogether. And some of the basic learnings, one was that don't focus on only EPS, focus on return on equity, have very focused portfolio, have chunky allocations, never time the market. I think one of the biggest thing is that never time the market, because you can never get it right. Never get it right. I mean, as an investor, you will never be able to get it right, and you will be spending so much of energy and time, which will be futile. And you will end up doing, instead of buying at the bottom and selling at top, you will end up doing buying at top and selling at bottom if you go for timing. And that if you look back, you'll realize that there are very few masters. At least I have not come across in this thing. The guys who have timed the market, they've gone anywhere. So I learned my lessons much earlier, that never time the market and buy high quality companies and buy fewer companies. You make money in the market because of the compounding, because of the entrepreneurship, successful entrepreneurship. Because the underlying guy is a Dhirubhai Ambani or a TCS or a HDFC Bank or a Infosys. Because they are successful in their business, you make a lot of money. Because you have bought small pieces of businesses. That I was very clear. I understood in 95 why we make money. And you have to be just there in the good places, good spots, and give enough time. It's like a time in the market, time in the stock is like a fertilizer. So that's what really happened. And by 1/1/2001, I had 100 crores portfolio. That 10 crore became 100 crores with some brokerage reinvestment and all, few crores. But it had become 100 crores. And by that time, I was going to Omaha, and again it crashed. I mean, I could see the crash coming, and yet I didn't sell anything. In the sense that I sold the stock, and I actually sold Infosys right at the top. Like when the market cap was about 110,000 crores. I sold bulk of my Infosys, which was 40% of my portfolio. 40% of my portfolio was Infosys. And I had made 12, 14x, 15x in just 2 years. And I was fascinated by Infosys, their campus, their attitude, their transparency, and the forthcomingness, and Mohandas Pai talking, with a loud mouth. So, and Narayan Murthy's vision. So I would have never come across a company like Infosys, and I made tons of money. But the foolishness I did, what I got out of my 40 crores selling, I invest immediately, quickly after the first fall. I went and bought some cheaper computer company at 15p, because I sold it 80p. I bought a 15p stock, and I thought the smartest guy on the earth. What happened? That 15p stock went to zero, and Infosys came back. So ultimately, my 40 crores became zero. So what is the big point in timing it rightly? So, this is what really happens. This is my experience, and everybody's experience is different, but more or less same. If you get rid of one good company, you'll always get a junk company. All the guys who surrendered their liver in when they wanted to increase their at 500 rupees, they all spent that money. The liver was with them for 25, 30 years, 40 years, earning nicely, dividend and everything. And the guys who surrendered it for 100 rupees or 200 rupees of premium, they all spend the money here and there, and now liver is whatever 2,000, and what you bought in replacement must be a junkyard. So I think that's the story of the stock market, and that is how it is going to be. I'm telling you, it is going to be far worse in the future. But you have to see, if he is complicated, you have to be simple. I mean, if you also become complicated, I think it is going to be your cost. I mean, that guy will remain always complicated. He is not going to change his character. He is going to be unpredictable. He is going to be quite nasty. He is going to be depressing. He is going to be very exciting. You can see whatever, but he is not going to change. You decide whether you want to change or not. So I have decided to change. I said market is always right. Let's accept all the mistakes that are ours, and conduct ourselves nicely. So by 2008, that 30 crores, 100 had become 30, 30 became 550 crores. It was 15x in the next 5 years. Mother of all the bull market, 2003 to 2008. Again it collapsed. I could see the collapse coming. I thought this time I'll be smart in running, but it all happened in 3-4 days. So we said, what is the point in selling? And then the market collapsed by 60%. And this time that 550 became 225, and that 225 in next 12-13 years has become 1850. I'm talking about just between myself and Muti, with small savings. That is what I'm talking about. I'm not talking about the company itself. Company is separate, Motilal Oswal. So, but what the thing is that there is 3 times I have seen 67% correction. And in February, I was in Calcutta talking to some 200, 300 people. And same question came, sir, what do you think of the market and all? So I said, ऐसा लगता है कि correction होगा और इस बार लगता है fourth time, चौथे time बुलावा आया है ऐसा लग रहा है. Like we are ready for fourth time deep correction. And what do you mean by deep correction? At least 50% correction. So I'm mentally ready for 1,000 crores loss in my portfolio. I mean, I don't wish that way, but I'm mentally getting ready for a fourth time kind of a call because there is no other way. It is like a COVID kind of thing. I mean, this is a COVID of portfolio management in the sense that it comes every 10 years. It gives you bite of 50, 60%. And if you survive that, then you have the next 10 or 15x. That's been my experience. I hope in next 10, 12 years, when I remain invested, I get another 10x, 20x to my current portfolio. And I mean, this has happened 3 times. And I think it will be even faster. See, what happens is, as the cut is deep, the resurgence is also deeper, faster. And the spring is, because what is, COVID has come, it will go. I don't know the date, whether it is 6 months, 9 months, 1 year. So many labs are working, or we may learn to live with it. A lot of things will change. Maybe work from home, maybe distance working, distance learning. Whole lot of distance is going to happen. It will be a different world altogether. Because the thing which didn't happen for 10, 12 years in terms of technology, it has all been tested in the scale nobody has ever seen. So now nobody can say Zoom doesn't work or meetings in the online doesn't work or talking to you all 300 guys. I just did 15 days back, Chartered Accountant Institute hosted all over the world 3 lakh chartered accountants on some blue jeans. 31,000 guys logged this thing. They listen for 2.5. So what I'm saying is that this is a very different world, completely different world. And probably I'll go to the office, sit in my table, and I still do Zoom. I would rather walking into any kind of a meeting room. I think relevance of physical meeting room. We have 28 meeting rooms of different sizes. An entire floor of 20,000 square feet is there in my tower. I think half of it will use it as a working space now. Another half only will keep. So I think I don't know when will the guests will come to our office, and when we will go to visit Singapore, Hong Kong, New York. I don't know. So at least let's use that office for that longer period. So what I'm saying is it's a changing world. What all will change, nobody knows. Last 10, 15 years gave birth to China, and till 2000 nobody knew China. So new things is happening. It looks all the planetary movements are happening for India to happen. Oil prices are low. China is unpopular, and I mean everybody wants to be friend with Modi somehow. I don't know what he has done. So it's a moment for India. The world wants India to happen, except for Indians. So I hope we are able to. I mean this. What is that? 10% of GDP. What is that thing? Nobody has time to even watch what is coming. So we got to handle ourselves well. We should present ourselves to be competent. We have capability to launch satellites, run the world. We are running Microsoft. We are running Google. We are exporting $150 billion worth of software every year, growing 10% even from here. So it's not a mean achievement from a country like India. And now I was just talking to one software company just before this, 4 to 5. And he was saying that this on-site and off-site, the whole thing is blurred. If everybody is working from home, how does it matter you're working from New York or you're working from Nagpada or something, So, I mean, there is nothing like on-site now. So he's saying that the whole damn, this nakara of doing it from Boston or doing from Mexico, doing from some Arizona or something, I mean, it is over. Whether the company wants to contain it because of protectionism or something, that's a different ballgame. But I think the whole software game has become offshore. I mean, where the cost is lowest and competence is highest. So I think it is a moment for India. Post-COVID, a lot of these things will happen. I'm just trying to be optimist, and but there are a lot of challenges. While COVID is on, the whole economy is broken down. getting into lockdown is one thing, but getting out is, I mean, as Kotak said, it is like getting out of the Chakravyuh, and he could never get out. He died actually. So I hope we get out of this Chakravyuh at some minimal cost, and that is a challenge actually. I mean, now the governments, I mean, the biggest hurt party between citizens and government, it is the government. I think you and me have time to pay for whatever luxuries, but I think government is in very bad shape. Their finances are completely gone for a toss. They always remain constant, but now, this time they are completely in disarray. And they have the printing machine, but we don't have printing machine. But I think printing machine limit is also controlled by S&P worldwide. So I don't know what they do. So we have to be. So I am quite sure they will open like liquor. Liquor was banned forever. Now they want to send liquor to your home because they can collect some money. So that's the situation of governments to collect some money from you and me. I won't be surprised if some taxes also come in this next budget or even before that. So, but post-COVID, whenever it happens, I think some crazy things will happen in the world in the sense that you cannot visualize. Like at the bottom, you don't know what the top is going to be, and at the top, you cannot figure out what the bottom will be. 3 months back, US was all-time high, 31,000 Dow, and full employment, zero inflation. It has never happened in the history, and nobody knew it is 11 years extended bull and how it will come to an end. You see in 3 months what has happened. So it is very difficult to figure out. The best thing is to take care of yourself, take care of your portfolio, be very cautious. Money is very precious. Whatever you earn, whatever cash you have, it is extremely precious. And my sense is markets are far more optimistic than the current situation is. Though the longer term it will be better. I mean, it will always, long term, everything is bullish and everything is going to be great. But looking today, businesses are in shambles, and automotive is zero. The whole lot of businesses which are zero, theaters. I mean, they don't know what will happen. Will they ever be able to open the gates, or when will they? All the airlines are finished. Tourism is over. So traveling, conferences. I mean, big fat marriages. I don't know what the Indians will do. All these pundits, what they will do. So so there's a lot of challenge till COVID is there. All the temples are empty. So I think this is a challenge right now. I think we'll see a complete birth of completely new world. But what happens is that COVID will go, but the corporations, the businesses, the consumers are not going anywhere. Consumers are living 24/7. System is not designed for lockdown because consumers are not locked down. You and me are living entities 24/7. So consumers can forego their discretionary spend, not the essential spend. And that's why Maggie noodle, they are not able to punch enough. They are not able to supply enough. And so whatever is the basic need, you have to design your portfolio more around essentiality of the consumer, not because the discretionary spend will never come back. It will come back, but the world will value the essential companies around essential value, essential needs much higher than the discretionary ones. That is for sure. The guys who are shot dead right now, just about dead, and they come back, they will never get the P multiple what they got pre-COVID. That will be definitely the change. And so a lot of these things which are around essentials, like say telecom, technology, I think these things have done. I mean, we cannot live right now. It's such a wonderful thing that hundreds of guys we are talking to directly one-on-one, thanks to technology, riding on telecom. So I mean, I'm not a great technology guy, but I'm understanding the importance of it. And I think, so business after business, it will come out, how essential, what are the things which are essential, what are the survivors and prosperers of this COVID, and what are the losers and, damage kind of entities out of COVID. So you have to align your portfolio, and this is the time to do health check of your COVID check of your portfolio. So Buffett did his COVID check, and he found that he has a 4 airline stock, 10% each of that owned in his portfolio. True. He badmouthed those companies, that industry for 30 years. And then he went and he fell in love with the company business and bought 10% each of that companies. And now he sold 100% of them. He said, I don't know what the hell is going to happen to this industry, so let me be out. And he sold every single piece of it. He didn't reduce by 80% or 70%. So this is the time when you find you're stuck in every portfolio, you'll find some. The bad stocks are there, you have to clean it up. And if you're not competent, then you quit the market only. So it is important to clean your portfolio of the bad stocks and hold good stocks which are going to be prosperous, is going to prosper in the future. And you'll also see that every smart guy will have their share of mistakes. So it's not that Buffett has committed mistake in airline stock means he's a bad guy. He's saying that my batting average, if I buy 50 companies, of that, if 5 or 7 or 10 companies go wrong or go bad, that doesn't mean that I'm a bad picker. At least 80%, 90% of my picks have been fantastic. He's the same guy who bought for 400 billion iPhone, Apple. And today you see what is the condition. So the point is that you have to buy good companies. Only good companies will compound in the future, not the bad ones. Bad ones, they become 0 to 0. And we have seen enough of it in last 12 months. And COVID has done the final blow to them. And those companies have, I don't think they have any chance of coming back. So you have to be very clear. Managing money, it looks very simple, but it's very difficult. The stock market looks very simple. You can hear something in one party or other and go and buy. I find people far more amenable to buying something which they've heard in the one drink party in the evening than helping a little bit $100 or $200 to somebody. So they can forego. I mean, it is so crazy. I mean, people call me up. A lot of small guys, they call me up and say, "Sir, I have 5 lakhs rupees, 2 lakhs rupees. What do I buy?" I get it. What do I buy? I mean, this is like they want to buy stock, you know. So, and he doesn't know what is stock market, and yet he wants to buy stock. You imagine what is going to happen to him. And if I tell him with all sincerity, a stock, after that, obviously I'll forget. And that damn thing goes to 0. For the whole life, he'll curse me. So the issue is that a lot of people in this country, they are trying to, not only here, all over the world, they are trying to manage equity stock portfolio on their own. I can tell you this is definitely not the time to start managing. If you're good, of course you must manage. But if you're not good, this is not the time to start. This is like start swimming. When you want to learn swimming, don't go alone in the swimming pool. Otherwise, you'll not come back. So you have to go with a coach, and who is better than your script box to advise you with whom to go. I mean, they are the guys to go with, and they will tell you who are the good managers. All the managers are looking like fools. You know, you are looking smarter than the manager, but manager's life is terrible. I can tell you this. You can appraise them looking backward, but they have to manage looking forward. That's the biggest challenge. You know, so they're smart guys, and the asset management houses are employing them because they're smart, and whole lot of hard work is being done. You cannot imagine for not doing anything in your portfolio how much they have to work. So it's a lot of hard work, and despite that, results don't come out sometimes, you know. And sometimes results are so good that you cannot believe that you did it. In fact, I'm telling you, I'm so surprised by some of the results that a lot of guys, they give me credit for that, but it is not me. It is the entrepreneurs underlying, you know, and we are lucky to be buying them and not selling. That is most important. So this is the story of, it's a lot of fun, but don't take it too seriously, stock markets, in the sense that you decide how much you can take this fun, and don't overdo. If you can take 50%, don't go beyond 50%. And in good time as well as bad time. In bad time also, don't go below 50%, and go for holidays, definitely for sure, when the markets are down. And when markets are up, sit on the head of Scripbox and take your whatever correction or balancing or whatever. So I think this is again, you know, decadal cleansing, and always the stories are different. And you have to take the knock, and one thing I'm very clear: this is not done in 70 days. this problem is not a 70 days problem. So we are not going to hit the bottom and again restart the journey from tomorrow or something like that. 2000 took 13 months or 18 months. 2008 took 13 months. So it can't be 13 weeks. It has to be much longer. And COVID itself is still around. So obviously, officially problem is not over. So whenever officially problem is over, then we'll start doing the damage. Then assessment of damage, then damage control. So I think, we are still in lockdown. So I think I clearly see that markets are a little more euphoric than what it should be. We should be very careful. But obviously there is a damage. A lot of stocks are damaged, particularly financials are damaged very deeply. And we must put out wherever we think that companies are good and we understand them. You must not hesitate in buying, and if you understand it is bad, you should not hesitate in selling also. So that's how it will go. But I will not quit the market and time the market, and at 7,500 again I'll come and buy. If I quit, market will not go to 7,500, and if I don't quit, it will not go beyond the current levels. So that's the kind of thing. But I know one thing: in next 10 years, we're going to make a lot of money. This is the honest submission. We'll take few questions.
Thank you very much, Mr. Agarwal. That was absolutely fascinating and energetic and absolutely energizing, I'm sure, for everybody. You've answered most of the questions very clearly, and thank you for the kind words about Scripbox. We basically tell people to follow a process of asset allocation, remain invested. 70% of our customers follow a very stringent SIP kind of thing. So thank you once again. The questions are largely around what are your views on the next so the people who are sitting on certain corpuses, is this a good time to enter the market? Right? There are people who either got a bonus or some other piece, or they've had some money which they've been waiting for the right time to invest. We've been telling them that there is no perfect time. Whatever suits you. So something called a smart transfer plan, put money into liquids, and over the next 12 months, move a certain amount every month. So something like that, what would be your advice, sir?
So something like that only, in the sense that don't go in tomorrow full hog, but yes, plan it for, this is a luxury of investing. Next 6-8 months might remain gone nowhere kind of thing. It will go up 300 points, come down by 300 points. I don't think till COVID injections are found and injected in human body clearly, I don't think this problem is over. So in fact, one problem will lead to other problem, and one damage will lead to another damage. So you have to be very cautious. You can even relax for some time, but definitely SIP, longevity SIP, planned SIP is a good way to go about it. And you can even think about one thing which is coming out is that technology, even diversification among the markets between India and say US to start with. I think we have to start learning to diversify a little bit. Thanks to NASDAQ, I think the best performing fund has been our NASDAQ ETF. In rupee terms, it has done amazingly. I think some 30% compounded. It has done 27-28% compounded for 7-8 years. So I think it has done very well. I think NASDAQ or S&P 500, at least some portion, 5-7%, 10%, not big one. But I think we should start looking at that diversification also within equities. That's also equity. So if it is 50% is equity allocation, maybe 10% of that or 20% of that, these indices, at least start with the US. That's the most reliable one. If at all want to lose the money, lose with the US, some other country.
I mean, just to add to what Mr. Agarwal said, we do within the Scripbox portfolio of Wealth Edge, we do have about 10% in international, basically tracking indices, exactly according with your philosophy that it helps to diversify your portfolio and especially uncorrelated stocks. The other question that people have been asking a little bit about is the whole thing around debt markets in general. Obviously, with the Franklin Templeton episode, sort of exacerbating some of the concerns that what do you expect to happen in the debt markets, sir?
See, I'm not the good guy. Probably you, Mr. Singhal, you might be a better guy to advise anybody, or maybe you can get. But see, I never bought debt ever. So what do I tell? But I think that 0.5% yield, extra yield, is not worth it. If the safe ones are giving you 7, don't go for 7.5, go for 6.5. I think I would think that debt market is not to make money. Debt market is to preserve your purchasing power. And if you can't take, see, basically it's a capital guaranteed schemes. So you have to see that your capital is guaranteed and you are protected from the inflation. And if you're lucky, you can get 2-3% on top of it. Don't try to speculate in the debt market and make, because then you are going to the junk. I mean, this entire Franklin Templeton is about buying into junk and layering it off with a AAA, and you're making 10-12%, so you're pretty happy, and they get a lot of money, and then finally the junk showed its color, and now everybody is crying. So I think it is very clear that if you get more than anything significantly higher than the risk free, there is some risk attached, and risk is not visible. And risk is not visible, and advisors are also not able to do enough cautioning of the risk associated with the higher yield. But every bit of the yield has that risk associated, which is not explicit to anybody. So you decide how much risk you want to take. I would think instead of 50-50 debt equity, you go 60. I mean, जितना risk लेने का सब equity में लेने का, and जितना capital guaranteed रखने का सब इधर रखने का. So you go 66% equity, and that has enough casino effect, and 33% keep it very safe and stable. So decide how much risk. I mean, what is the point in losing money in debt fund? There's no point in losing. I mean, it is better to lose in the equity side. Debt side should be always very firm and stable, absolutely guaranteed. Because out of my 100 crores, 50 crores I'll keep in debt, and I can retire with 50 crores. Let that 50 crores go to zero, that equity. But finally, that 50 crores equity will become 500 crores after 10 years, and this 50 crores will barely become 100 crores or 150 crores. So that's the nature of it. But if by chance that 50 doesn't go to 500, it goes to zero, my retirement is not impacted. So that should be the kind of way I would look at like that. So
thank you very much, sir. I mean, to all our panelists and to especially to Mr. Raamdeo Agarwal, we apologize once again that it took some time to get you online, and we were not very clear. Thank you for answering all the questions. I mean, most of the questions are in the same nature. With sectors you answered about remaining invested, buy right, sit right. We have something which says fill it, shut it, forget it. Which is obviously a copy from the Hero Honda. But aapka ye buy right, sit tight, which is like a takya kalam. It's so simple and so powerful. Just tell us a little bit about that, sir.
How did we come out with this particular slogan?
Sir.
So, we always thought of doing marketing in slightly around Buffett thought process. So actually in 95, 96, we used to buy, we didn't have money in 95, 96. So we used to buy one column, 1 inch by 1 column in ET, Economic Times, in the front page. We used to buy 1.5 inch on 1 column. You can imagine how small I'm talking about. And that used to be our innovation. Ki bhai, itna chota le, lekin front page mein le. Nobody can miss it. And we used to send a thing called I think it used to be every Monday. And we used to send so we had a marketing consultant, Samsika, Jagdeep Kapoor. So he said, you position yourself as world-class research broker. Self-assumed, you are world-class research broker. We had some research, but he said, write the damn thing, world-class research broker. So we started writing and believing that we are world-class research broker. That's how that positioning started, of research-oriented. And second, we used to use the Buffett quotes. People used to, and the thing was the space was so limited that it had to be fitted in 13 words. So I used to take a very long quotes of Buffett, and I used to reduce into 13 words. I mean, it was a pressy writing. I used to sit in an airport, anywhere, and I used to do that 13 words. And that's how, you'll see the collection of wealth creation thought, the thin book. And those are all the quotes out there. So that's how we started building our marketing. Low cost, extremely low cost. I mean, it used to cost about 5-10 lakhs per year. So that's how we started building. And then all the quotes, I mean, buy right, sit tight, this think equity, think Motilal Oswal. So this was also, one of the discussions with the marketing guys. So we thought of that old slogan of Jensen Nicholson. I mean, in the 80s, they think of color, think of Jensen Nicholson. So we borrowed the concept from there, and then we said, think equity, think Motilal Oswal. So that's how. So buy right, sit tight was also one of these discussions where it came out. Solid research, solid advice, then buy right, sit tight. Buy right, sit tight is actually Charlie Munger Buffett actual direct quote. We just picked it up. And maybe it must have been a little longer in some context. We just picked up that thing. So that's how, but we go with our own conviction. We don't bother how it will look. We will just go and do it. Like right now, you might be seeing the, don't try to catch the bottom. That there is a new campaign. We have come out, think equity, think Motilal Oswal in that. Don't try to catch the bottom. So we thought for next 6 months, people are trying to go into catch the bottom only. So let's start with this campaign. That don't try to catch the bottom. I don't know who knows what is going on the bottom, but don't try to catch the bottom. So that's why that, so, and that when it was already under COVID, when I thought of this, so he said, let me just find a YouTube video and convert into advertisement. So the moment the advertisement was ready, when we asked some guys, they said, this character looks like a Chinese guy. So can you do some Indian? I said, boss, ye to kharida hua bahar se. So this is how, this advertising is some crazy thing. But it works very well. It gives a lot of recall. It gives a lot of fun. If you see the advertisement, it's very naturally shot. The guy tries to catch the flyer and saucer, and he falls flat, absolutely goes right through. So if you are trying in the stock market, if you are trying to catch the bottom, you'll never be in the market.
So like somebody just said on the panel, yes, sir. And I can completely mirror what he's saying. 1 more hour, and I think people would still be fascinated and hooked onto every word. But it is 6 o'clock, so I don't want to hold you any longer. Just want to thank you very, very much, Mr. Agarwal, for your time. It's been a privilege and a pleasure for Scripbox and for myself, and I'm sure for all our participants to have you in, beyond, above the bottom, whatever it is. So thank you, and to all our tight, follow the basic principles of good companies and good mutual funds, and let the experts decide. Like you said, they are well-picked fund managers. They know their job. Let's trust them in their ability, and let's support them to give them more money. Thank you, Mr. Agarwal, very much. And please be safe. And thank you everybody. We'll be dialing out.